All right, so you've sent over some really interesting stuff about how these pro traders kind of break down the markets. And, for this deep dive, I think it'd be really cool to try and unpack their main strategies,
Okay.
specifically looking at technical and fundamental analysis.
Yeah.
Our goal here is to give everyone a really solid understanding of these approaches. What are the tools they're using and how are these pros actually thinking
Right.
without, completely overwhelming anyone.
Of course.
We'll kind of explore what these methods are. How do they actually differ from one another?
Yeah.
And then importantly, how might this be relevant to, anyone's understanding of how the markets move?
Yeah, absolutely. I think the sources you've pulled together are really excellent for this because we get a really strong dive into how these traders are actually looking at the market, whether that's through technical analysis or fundamental analysis.
Hmm.
And then on top of that, we've got some good stuff in there about specific chart patterns, indicators that they're using. And then that interesting sort of contrast between retail traders and institutional traders.
Right.
So I think there's a lot of really rich stuff in here that I think listeners will be able to take away and actually use.
Okay, so let's dive into this then, starting with kind of the fundamental divide here, technical versus fundamental analysis.
Okay.
The material really highlights these as the two main ways to kind of size up the market.
Yeah.
So for someone who's maybe just getting familiar with this, what is the essential difference between these two approaches, and when might you find one to be more insightful than the other?
Well, I think what's fascinating here is really where they focus their attention.
Sure.
So technical analysis, as you've pointed out in the sources, it's all about the price itself. So we're looking at charts, patterns, indicators that are derived from that price action.
Right.
And it's essentially trying to look at how the price has moved historically to project where it might go in the future.
Yeah.
And this tends to be the domain of shorter term traders. So people that are, making trades in a matter of days or weeks.
Right.
As opposed to, longer term investors.
So it's like reading the market's, minute-to-minute story through its price fluctuations.
Precisely. Yeah, it's very much about, trying to predict the next wave by looking at, the currents and the wave patterns that we've seen previously.
Okay.
Now, fundamental analysis, on the other hand, takes a much broader, a much longer term view.
Okay.
So it's really digging into the intrinsic value of an asset. And that involves looking at, economic indicators, company earnings, the overall health of the market that asset is operating in.
Right.
And so the goal here isn't necessarily to catch, the next short-term price swing. It's really to determine if this asset is inherently undervalued or overvalued.
Uh-huh.
And so this approach tends to be, more popular amongst long-term investors and these larger institutional players.
Right. So one's very focused on the immediate pulse. The other one is conducting a really thorough health check.
Exactly. Yeah, I like that analogy.
But, the sources also mentioned that a lot of professionals don't operate in one camp exclusively.
Mm-hmm.
They often blend the two.
Yeah.
So how does that synergy kind of play out in the real world of trading?
Well, if we kind of zoom out a little bit and connect this to the bigger picture, fundamental analysis can really paint that broad canvas.
Okay.
So, for example, is the overall economic landscape favorable for, let's say, the technology sector?
Mm-hmm.
And then technical analysis can step in and provide those finer brushstrokes.
Right.
So, okay, the fundamentals might be screaming that, this company has strong long-term prospects.
Okay.
But then the technicals can help you pinpoint, when might be the most opportune moment to actually initiate a position in that sector.
Right.
So it's very much about marrying that underlying value proposition with the market sentiment at the time.
Okay, so almost like choosing a vacation destination based on the climate and then booking the flight based on the best price trends.
Precisely. Yeah, I love that analogy.
All right, so let's dive into the nitty-gritty of technical analysis now.
Let's do it.
The material that you shared highlighted some key chart patterns.
Yeah.
And let's start with the head and shoulders pattern. I mean, it sounds almost Shakespearean.
It does, doesn't it?
What's the drama behind this pattern?
Well, the head and shoulders pattern is a very dramatic visual cue, and it often signals a potential turning point in a trend.
Okay.
So if you picture this on a chart, the price makes a high the left shoulder, and then it pushes even higher to a new peak, the head.
Okay.
And then it rallies again, but only to reach a high roughly equal to the first shoulder, that's the right shoulder.
Right.
And these peaks are joined by a neckline. And the crucial moment comes when the price breaks below this neckline after forming the right shoulder.
Okay.
This is often interpreted as a strong indication that an upward trend is losing steam, and might be reversing into a downward trend.
So it's almost like the market tried 3 times to go higher and failed,
Exactly, yeah.
and that last attempt was even weaker than the first.
Yeah, it's essentially a failure to keep pushing higher and then a break of what had previously been a support level.
Got it. Okay. What about triangles? The sources mentioned a few different types: ascending, descending, and symmetrical.
Yeah.
So what distinguishes them, and what kind of signals do they typically send?
So triangles represent periods of consolidation where the price range is narrowing.
Okay.
So it's like the market taking a breather before its next move.
Okay.
A symmetrical triangle forms when the price is making lower highs and higher lows. So it suggests a period of indecision.
Mm-hmm.
An ascending triangle has a flat top resistance line and a rising bottom support line, and this often indicates building bullish pressure.
Okay.
Conversely, a descending triangle has a flat bottom support line and a falling top resistance line, and this often hints at increasing bearish pressure.
Right.
So what these patterns suggest is that, this period of consolidation is coming to an end, and a breakout, a significant move in one direction or the other is likely. And the shape of the triangle gives us an indication of the potential direction of that breakout based on where that pressure seems to be building.
So it's almost like a coiled spring just waiting to release energy in either direction.
Precisely, yeah.
And then we have double tops and bottoms, and these sound like they're about the price hitting a ceiling or a floor. It can't break through.
You got it.
Yeah.
So double tops typically appear at the tail end of an uptrend.
Okay.
So the price tries to push past a resistance level, fails, pulls back, and then tries again only to fail a second time.
Right.
This suggests that that upward momentum has likely run its course, and a reversal to the downside could be imminent.
Okay.
Double bottoms are the mirror image of that, so they form at the end of a downtrend,
Got it.
when the price tests a support level twice and bounces back each time.
Right.
And this indicates that that selling pressure is likely exhausted, and an upward reversal might be on the horizon.
So these are powerful patterns suggesting a strong rejection of a particular price level.
Absolutely.
Yeah.
Very strong signals.
All right, moving on to the tools then that help traders interpret all these patterns, the essential indicators.
Yeah.
The material that you shared listed moving averages, RSI, MACD, and volume indicators.
Yeah.
So let's start with moving averages, specifically the 50-day and 200-day.
Yeah.
Why are these specific time frames so closely watched by traders?
Well, the 50-day and 200-day moving averages are really popular benchmarks because they represent different time horizons.
Okay.
And they're very widely followed by, a huge number of market participants. So the 50-day moving average gives us a sense of the short to medium-term trend, whereas the 200-day is often considered, a key indicator of the long-term trend.
Okay.
So when a shorter-term moving average crosses above a longer-term moving average.
Like the 50-day crossing above the 200-day.
Exactly. That's often referred to as a golden cross.
Right.
And it's generally seen as a bullish signal.
Okay.
It suggests that upward momentum is gaining strength.
Uh-huh.
Conversely, we have what's known as a death cross, which is the 50-day crossing below the 200-day. And this can be interpreted as a bearish signal indicating weakening long-term momentum.
Okay.
So they essentially help to smooth out the daily noise and give us a clearer view of what the prevailing trend is over these different periods.
Got it. And then there's the Relative Strength Index, or
Right.
RSI.
Right.
The sources mentioned this helps to identify overbought or oversold conditions.
Yeah.
So how does that mechanism actually work?
So the RSI is a momentum oscillator that oscillates between 0 and 100.
Okay.
And generally, a reading above 70 is considered overbought, suggesting that the asset may have risen too quickly and could be due for a pullback or a period of consolidation.
Okay.
Now, a reading below 30 is typically considered oversold.
Right.
And this hints that, maybe the asset has fallen too sharply and could be due for a bounce.
Okay.
Now, it's important to remember that, an asset can remain in overbought or oversold territory for extended periods, especially during strong trending markets.
All right.
So the RSI is often most effective when it's used in conjunction with other indicators.
And a solid understanding of what the underlying price action is actually doing.
Okay, so it's not a standalone signal.
Precisely, yeah.
All right, next up. MACD, moving average convergence divergence.
Yeah.
This sounds a bit more mathematically inclined.
It does a bit more technical.
So what's the core idea behind this indicator?
So the MACD looks at the relationship between two exponential moving averages, a shorter term one and a longer-term one.
Okay.
It calculates the difference between these two moving averages.
Uh-huh.
And then it plots a signal line, which is usually a 9-day moving average of the MACD line itself.
Right.
So traders often look for buy signals when the MACD line crosses above the signal line
Okay.
and sell signals when it crosses below.
Right.
Now, another key aspect is looking for divergences.
Okay.
So, for example, if the price is making new highs,
Uh-huh.
but the MACD is making lower highs,
Right.
this could be a sign that upward momentum is weakening
Okay.
and that a reversal might be in the cards.
So you're looking for that mismatch, essentially.
Exactly, yeah. Okay, and finally, volume indicators. The sources really emphasize their importance in validating the strength of price movements.
Yeah. Volume is key.
So why is tracking volume such a critical element?
Well, think of volume as, the level of participation or conviction
Okay.
behind a price move.
Okay.
So high volume during a price advance or decline suggests strong interest and agreement among traders. If a price breaks out to a new high on heavy volume, it's generally considered a more reliable signal
Okay.
than a breakout on light volume, which might suggest a lack of strong conviction
Right.
and could be more easily reversed.
Right.
Conversely, low volume during a price move might indicate a lack of significant interest behind that movement, making it potentially unsustainable.
Okay.
So volume essentially helps you to gauge the level of commitment behind price signals and chart patterns.
And the material also included a really valuable note: avoid overloading your charts. And that makes perfect sense. It's tempting to think that more indicators equals better analysis, but it sounds like that can actually lead to confusion and conflicting signals.
Absolutely. Too many indicators can lead to what's often referred to as analysis paralysis,
Okay.
where you have so many conflicting signals that it becomes difficult to actually make a clear decision.
Right.
So the most effective approach is often to select a few key indicators that complement each other
Wow.
and that align with your overall trading strategy and time frame.
Okay.
Focus on truly understanding what each indicator is telling you
Right.
and how it either confirms or contradicts the underlying price action.
So quality over quantity.
Precisely.
All right, let's shift gears a bit now and think about how different types of traders approach the market.
Okay.
The sources drew a contrast between retail and institutional traders.
Yeah.
So what are some of the fundamental distinctions in their focus and the tools they utilize?
Well, you rightly highlighted that retail traders often focus on individual stocks or, specific currency pairs. It's what they can readily observe and analyze.
Right.
Institutional traders, on the other hand, tend to adopt a much broader macro perspective.
Okay.
So they're not just looking at a single asset in isolation.
Yeah.
They're deeply concerned with overall market liquidity.
Okay.
So, you know how easily assets can be bought and sold without significantly impacting their price?
Right.
Market depth, which essentially shows, the volume of buy and sell orders at different price levels, and then the overall order flow,
Yeah.
which gives them insight into the direction and size of the trades that are being executed in the market.
Okay.
So it's almost like, you've got a small boat navigating a lake versus a large shipping fleet that needs to understand, the overall ocean currents
Right.
and the port conditions.
Got it. And in terms of the tools at their disposal, it sounds like institutions have access to some pretty advanced technology.
Oh, they certainly do.
Uh,
Algorithmic trading, often referred to as algo trading,
okay.
or automated trading, is very common for institutional traders. And this involves using computer programs to execute trades based on, predefined sets of rules.
Right.
They also frequently utilize what are known as dark pools,
Okay.
which are private exchanges that allow them to execute large trades anonymously. And by doing that, they minimize the potential impact of their large orders
Right.
on public market prices.
Right. So they're not moving the market themselves with their trades.
Precisely.
So while these are powerful tools driven by huge amounts of data
Yeah.
and this sophisticated automation,
Uh-huh.
it's important to remember that human judgment, strategic oversight,
Right.
and a deep understanding of market dynamics still play a really vital role.
Absolutely.
One point that really stood out in the material was the huge emphasis on risk management by institutional traders.
Yeah.
The sources mentioned things like hedging and diversification.
Right.
So why is risk management such a paramount concern for these institutions?
Well, for institutions managing substantial sums of capital, preserving that capital is often as important, if not more important, than aggressively maximizing every single trade.
Right.
So their primary fiduciary duty is often to protect and grow funds responsibly over the long term.
Right.
And so hedging strategies are employed to mitigate potential losses in one investment by taking an offsetting position
Yeah.
in a related asset.
Okay.
Diversification, which involves spreading investments across a variety of different asset classes, sectors, geographies.
Right.
This helps to reduce the overall impact of any single investment performing poorly.
Okay.
So the core principle here, and one that the sources really underscore, is that a disciplined approach to avoiding unnecessary risk is absolutely crucial for long-term success.
Yeah.
And that's true for any trader or investor, regardless of their size.
So for them, losing capital isn't just a setback, it's a failure of their primary duty.
Yeah, I mean, their risk management is less about maximizing every single trade,
Right.
and it's more about ensuring the long-term viability of their funds.
Okay.
So it's a crucial perspective, even for individual traders.
That's a really insightful takeaway. All right, let's touch on some of the common mistakes that the sources highlighted
Okay.
when it comes to chart analysis,
Right.
particularly for those who are newer to it.
Sure.
The first one was forcing patterns.
Yes.
What does that actually look like in trading practice?
So forcing patterns occurs when traders become so determined to find a specific chart pattern, whether it's a head and shoulders, a triangle, or some other formation,
Right.
that they start to interpret price action in a way that fits their preconceived notion,
Okay.
even if the pattern isn't clearly and objectively present.
Right.
So this can lead to making trading decisions based on, a flawed interpretation of the market's behavior, and it can ultimately result in unnecessary losses.
Got it.
So it's essential to maintain objectivity
Okay.
and only identify patterns when the criteria are clearly met, rather than trying to shoehorn
Right.
the market's movements into what you hope to see.
So don't be blinded by your own bias.
Yes, exactly. Another frequent mistake is over-reliance on indicators. The sources were very clear that indicators should be used to confirm price action, not as the sole basis for making trading decisions.
Right.
So why is having a solid understanding of that underlying price movement so fundamental?
Well, indicators are, by their nature, derived from historical price data.
Okay.
So they're essentially a secondary layer of analysis.
Uh-huh.
So if you base your trading decisions solely on indicator signals,
Right.
without understanding what the price itself is doing, the overall trend, key support, and resistance levels, the broader market context,
Right.
you're essentially navigating without knowing the terrain.
Right.
So price action is that raw, unfiltered data.
Okay.
And indicators should be used to add confluence and confirmation to what the price is already telling you, not the other way around.
Got it. So it's almost like indicators are tools that can illuminate the road.
Yeah.
But you still need to be looking at the road itself to know where you're going.
And then finally, ignoring volume. We've already talked about its importance in confirming price moves.
Yeah.
But why is this such a common oversight, particularly for those just starting out?
Well, I think often beginners are so focused on deciphering these price patterns and, the signals generated by these various indicators.
Right.
That volume can seem like a less obvious or a more complex element to consider.
Right.
However, as we've discussed, volume provides really crucial context about the strength of conviction behind a price movement.
Yeah.
So overlooking it can lead to misinterpreting breakouts and reversals.
Okay.
So a price move accompanied by strong volume is generally much more likely to be sustained
Right.
than a move on thin volume.
Okay.
So it's a vital piece of the puzzle for assessing the reliability of any trading signal.
So as you can see, the world of professional trading analysis is really fascinating.
It is.
It's this interplay of art and science, where the careful study of past price movements intertwines with an understanding of these broader forces that are actually driving markets.
Uh-huh.
So the key takeaways for you are to grasp the fundamental differences between technical and fundamental analysis.
Right.
Recognize the power of key chart patterns and indicators without falling into the trap of overcomplicating things.
Yep.
And to appreciate the risk-aware mindset that's so central to how institutional players operate.
I think that's a really important point, and the material you shared really drives this home, that it's not just about what tools professional traders use, but critically how they apply them.
Right.
So with discipline, a keen eye for context,
Right.
and that strong, unwavering focus on managing risk effectively.
Okay.
This gives you a valuable framework for approaching market analysis regardless of your current level of involvement.
Right.
It's about understanding the why behind these methods and actively avoiding common pitfalls.
Like forcing patterns.
Exactly, like forcing patterns or neglecting the crucial insights that volume can provide.
So this deep dive has offered a window into some of the core methodologies used by market professionals.
Uh-huh.
So consider what aspects really resonated with you? What further questions does this kind of exploration spark about your own approach to understanding these market dynamics?
Yeah.
Perhaps delving into specific real-world examples of these chart patterns playing out in different market conditions,
Right.
or further investigating the nuances of different volume indicators and how they can be used to confirm the validity of different trading signals.
Yeah. I think those are all excellent avenues to explore.
That could be valuable avenues for your continued learning journey.
Absolutely.
All right, so that's it for this deep dive. Thanks for listening.
Thanks for having me.